Hey, it's Demetrius, and in today's video, I want to do things a little bit differently. So I'm not going to go through an entire presentation or anything like that. But what I will do is talk to you about a particular case that I've literally been working on right now. And the couple that I'm going to be talking about, or at least the one particular person that I'll be talking about today. First and foremost, I'm not showing any names or anything like that. But the person that I'm going to be talking about, I think brought up a question that deserves a YouTube video, that deserves me bringing it out to the world, because I think if he's having this question, you guys are probably also having this question. Not only that, I've also heard this question multiple times throughout my career, and I figure, why have I not yet made a video on this? And so the point of this entire video, if you hadn't already seen the thumbnail, if you hadn't already seen the title, it's all about this. It's all about this idea of direct recognition loan features versus non-direct recognition loan features. And so I think there's a somewhat of a huge debate depending on the camps that you're in regarding whether or not you should go with direct recognition or if you should go with non-direct recognition. And so I think a lot of times when it comes to the camp that I came from when I got into the industry 7.5 years ago, the whole idea was you got to go with non-direct recognition. That is where you got to go. That's the best one, hands down. And then as I started to learn more, and I started to learn more and learn more and learn more over the years, what I've learned is that direct recognition and non-direct recognition ultimately can end up becoming a wash. I'm not going to get into the details of that particularly in this particular video, but it is important to note that both of them have their merits and both of them are good and neither of them are bad. Okay. And so I just want to set the level playing field right there before we get into the video, because ultimately we're going to look at some numbers and I'll show you and peel back the curtain when it comes to the conversation and the numbers that we were looking at with my client. So I want to start us off with the original illustration that we were looking at, and ultimately it may help for me to also show you or kind of tell you what the goals were of that particular client. So this client in particular, his goals ultimately were to potentially pay off his student loans quickly by utilizing some of the liquidity he already has anyway. So there's around $50,000 or so of student loan debt that he could just wipe clean in one fell swoop, because he's frugal. He's done a very good job saving. It's just a matter of like that cognitive dissonance about, do I pay off all this debt when I'm really not in a bad financial position, or do I not, right? And so that's kind of one of the goals. And ultimately beyond that, he wants to be able to borrow against it to make investments to create more cash flow. Okay. So that's kind of the background of this particular person. And so the first carrier that we looked at, it is Guardian Life. If you've heard of heard of that life insurance carrier before. And so the amount of premium that he's looking to put into it, the contribution is $110,000 for that first year. And then somewhere in the neighborhood of $15,000 per year is what he's looking to contribute moving forward. And so if you move over and take a look at the net cash value column, what you're going to find is that there's $102,369 by the end of the first year. And so just to kind of keep things quick here, what you're seeing is by the time he's put in $395,000 by the 20th year, what we're seeing here is just shy of $600,000. So there's $598,722. So if you're wondering also about, is this the direct recognition carrier or is this the non-direct recognition carrier? This is actually the direct recognition carrier. Okay. And so what I'm going to do is actually show you guys what I showed him, which was what is the impact of the cash value if you were to take a policy loan for some of the things that you're looking to do, whether that's pay off student loans, make an investment, or what have you, right? So let's take a look at that. As you can see here, you'll notice the $52,500 of annual loan. And ultimately, this is because of the fact that there is loan interest. And at this particular carrier, the loan interest is actually 5% even. And so they're including that in the loan for the particular year, because what we're also assuming is that we're not paying back the loan over time, but we're going to wait and to pay it all off in one fell swoop by the 10th year, which is why you're seeing this $63,814. That's the pretty much the 50,000 plus the accrued interest over the years. And then you'll see the $78,000 figure here. That just includes the premium as well, because we're assuming that we're paying the premium in addition to paying off the loan in the 10th year. So what you're going to find is that by the 20th year, way down here, okay, what you're going to find is that in this 20th year, the cash value, which is this number right here, is $589,839. That's a difference of $8,883. And so for some people, they look at that and go, well, I got over $500,000. If I got an $8,000 difference, who cares? But other people look at that and they go, that's an $8,000 difference. Give me my money. And so that's ultimately the camp that this particular client was in, right? He is someone who values efficiency to a great degree. And with that said, if wherever he can get more efficient when it comes to the cash and the place that he's storing that money, he'd rather do that. And I don't think I shared this context with you before, but ultimately, this $110,000 was just kind of sitting in bank accounts, and he wasn't doing anything with it. He has money in other places as well, but ultimately, for the safe place that he wants to store money, life insurance is that place for him in particular. Now, what I want to show you is another illustration, and this is going to be the non-direct recognition carrier. Specifically, we're looking at Mass Mutual in this particular case, okay? And so you'll notice that the numbers don't look exactly the same in terms of the Guardian illustration versus the Mass Mutual illustration, which is this one on the screen here. But the moral of the story will be that the two Mass Mutual illustrations will be the same from a contribution perspective, and then the two Guardian illustrations will also be the same from a contribution perspective. And so what I'm looking to show you, and what I showed him over time, and the reason the numbers are different is just because conversation and emails back and forth and all that sort of stuff. But ultimately, what I'm looking to show you in this particular video is simply the fact that there is an impact on your cash value long term when you have a direct recognition loan feature versus when you have a non-direct recognition loan feature. And so in this particular case, what I want to show you is by this 20th year, right, his cash value is $511,850. This is the cash value without any loan whatsoever. Now I want to show you a slightly different one. This one, we're actually showing a policy loan, and that policy loan is coming out here in the 5th year and is getting paid back by the 10th year, okay? And so by the 20th year, I want to show you still $511,850 is the total amount of cash value that he has. That's the proof right there that there is a difference between direct versus non-direct recognition. And so when I shared that with my client in particular, what he said was, you know what I'd rather have is to know exactly that no matter whether I take a policy loan or not, I just want to know that my loan is not impacting the growth of my cash value. And throughout conversation, he started to realize that even though he had a misconception of direct recognition, like many people do, he still would rather have the non-direct recognition loan feature just because of his value set. And so that's one of those things that I had not yet shared within this particular video, because I kind of recorded this off the cuff and I wanted to just kind of show you through how I think and how I serve this particular client. And ultimately, the difference between the two is that when it comes to direct recognition, there's going to be an impact on your dividend, which directly impacts your cash value growth as well. And so, for example, if someone has $100,000 of cash value and they take a $50,000 policy loan, their entire $100,000 will still get credited, but that $50,000 that's outstanding in terms of the loan will be credited a little bit differently. Okay. So in other words, let's just say, for example, the dividend rate was going to be 6%, right? But then you take $50,000 policy loan. Well, maybe now we're looking at 5.2% on loan dollars. And so the growth is still happening on both buckets of dollars. The difference is that there's an adjustment to the loaned dollars, if that makes sense. With non-direct recognition, it doesn't matter if you have a loan or not. It's not going to be adjusted. The dividend is not going to be adjusted, which is why you'll notice, which is what you saw, that after the long haul, you'll notice that there was no difference whatsoever in his cash value. And sometimes what I think is that when I talk about the difference between direct versus non-direct, some people may lean towards non-direct recognition, and I think rightfully so, but that does not mean that it's the superior one in all cases. The reason I say that is because there's reason why someone may want to go with direct recognition, and you have to look at the life insurance carrier themselves, right? What is the growth on the policy when you think about dollar for dollar, right? And so in some cases, depending on the life insurance carrier, depending on the health rating that you get, depending on the cost of insurance and all that sort of stuff, your numbers may look better at a direct recognition carrier than it would at a non-direct recognition carrier. And if the goal is potentially, let's just say, retirement income in the future, maybe the direct recognition carrier could look a little bit better. If the goal is maybe borrowing against your policy and you're doing it for long stretches at a time, or you're having max policy loans at all times, maybe a non-direct recognition carrier may make a little bit more sense. And so what I want to share with you here is that I just gave literally 2 examples. I'm not saying that you have to put yourself in either one of those camps, because everybody is so different. I mean, I've had thousands of conversations and helped put in force hundreds, literally hundreds of life insurance policies over the years. And the last thing that I would want you to deduce this down to is a binary. It's either this or that. right? And so what's really helpful is to have a conversation with someone who does this on a regular basis. And so if you're in that position where you're looking for guidance, you're actually looking to pursue getting a policy at some point, whether that's right now or in the future, go ahead and type the word me in the comment section. I'll be more than happy to reach out to you, help you out, give you a little bit of guidance. I promise you, I'm not going to try to sell you on anything by any stretch of the imagination. But what I do want to do is get clear on what it is that you're looking for, if this is something that you're looking to do, because it's less about what you're looking for within a policy, although that's important, but it's more about what are you looking to do? How can this policy give you more value with how you see it? And so if you're looking for guidance, or you're probably been getting the guidance, but it's been muddy water and it's been unclear, then go ahead and type the word me in the comment section. I'll be happy to help. So anyways, thanks for watching this video, and I'll see you in the next one.